What's going on, guys? Jay here, smarthelping.com. I've got a really great model. I built this off stream. It was a request that came in from a guy, and it's awesome. It's tracking a preferred return fund returns for up to 30 members of the fund. It can be expandable. I'll show you how to do that at the end. And let's just go through here, and I'll show you how it works. So we have first column, investor name. Column C, date invested. Column D, end month. So this is going to determine how long the investor is eligible to receive any distributions. The preferred return. This is huge here. This is saying that as long as the investor has invested, the clock starts, and then once there's a payout, these investors are prioritized that they get whatever the percentage is defined here for the first hurdle rate. They'll get that much of the cash flow until they reach an 8% return in this case, or whatever percent you put in here. And note, you can set this to 100%, and in that case, it would mean all cash flows go to the investor until they receive their 8% return. Then there's up to two other hurdle rates. So you've got the 8% return. We've also got a 15% in this case and a 20%. Now you don't have to use these, and you can always just, all that's going to happen is you can determine how the cash is split between the LP and GP at each level. So this is level 1, the first hurdle. And then if you beat that, you can determine how it's split after that. And these can be different or the same. It just depends on the structure of the fund. But it's really cool because you can have different start dates here, and all these investors are going to be in the same fund with the same GP, but they have different start dates and end dates, and the GP is going to have a proportional amount of investment based on whatever the LP rate is. So you could define this, let's say it was 90, 10. So whenever they invest, the GP also is going to invest at whatever reciprocal rate you have here based on this investment rate of the LP and their investment amount. So here we have all the LP funds contributed, all the GP funds contributed, and then we have the preferred return for the investors. Clock starts as soon as this date begins. Note the end month will exclude this date. So if this is March, that means March, any returns for March are not included, but any returns for February will be included. Let's see, what else do we got here? So we have return hurdles. Oh, and you can select the compounding period here. So you can do 1 if it's compounded annually. You could do 4 if it's compounded quarterly, or you could do 12 if it's compounded monthly, and that will affect this hurdle rate and how much is distributed over time. Obviously, 12 means it's going to compound the highest, and 1 means it compounds the least over time. And then we have some summaries over here. You can see total cash contributed for each investor, total cash returned for each investor, the total cash return for the GP, and the IRR of the LP and GP in each of these situations. Note, the main thing that will affect this is going to be the timing when profits are distributed and like the timing of these investments, because the clock starts sooner if you invest sooner. So they're going to be owed more, but if you invest later, you're going to have a shorter time period, so your IRR is likely to be higher. It depends on obviously when the profits are distributed, which we'll get into all of that here next. So this kind of defines you're setting the configuration for each investor. Cash planning. Here you can enter the launch year. This will drive the first month of the forecast period or tracker, or when it's tracked. It's not technically forecast. It could be forecasted. You can also use this for actuals. So what happens is we've got a couple slots here. So this is going to sum up all the cash contributed by the LP over time. This is based on the log and the investor list. You've got any withdrawals, which are just automatic based on the end month. You've got LP investments total over time. You've got cash contributed by the GP, and then we've got cash available. So this cash available is the most important row here. This is what you have to make sure is above 0, and this is where you're kind of managing the fund by saying, okay, I've gotten this much in contributions. I've got X amount being withdrawn. So what is my cash available to invest? And let's say it's this is for a property flipping endeavor. what this is made for, but really could be used for anything. So you've got cash coming in. You can deploy that capital here. In this case, let's just zero all this out. And I'll just go through. So we have a running log of the cash position over time. Let's say we're raising money for a few months here. Then we finally get all the money raised. We start deploying that capital in the properties. Let's say we deploy, 50,000 here, another 50,000, and then the remainder was 72,614.38. So here we've now deployed all the capital. So we have no cash left. We've got all the investor money from LP and GP. Now, at some point in the future, let's say there's profits. Let's say we got $500,000 profit. Whoop, that's 5 million. Let's say 500,000. And what you can do is to find the profit, and that's separate from distributions. So you can make distributions off of that profit, and you'll see the cash. You can reinvest the profits. It depends on how your operating agreement is set up for that, but you can reinvest it and deploy more up here. We can deploy, let's say we distribute 200,000 here. Now you can see here's a reconciliation of what was happening. So LP cash flow 160, GP got 40. This looks like a 60-40 split. Well, let's see. So what's our hurdle rate? 80-20. So if we look at one of these, you can see investor one here. Here's their log they invested. The clock starts. They're getting a preferred return. We're compounding monthly, so we have our annual 8% preferred return converted to a monthly compounded rate, so we know how much has to be compounded monthly to reach that annual rate of return. And so that's building, building, building. So this is saying at any point to get that 8% hurdle, this is the total cash that needs to be returned. We go, go, go. There's our distribution. So in this case, you've got 6,800 available. It's going to be split 80-20. So you can see 80% for the LP, 20% for the GP. We clear off. No, we don't. We still have a little bit left, so we don't actually break the hurdle yet. Let's see. Let's make the profit a little bit higher. Let's say it is, or the distribution. Let's say it's 300,000. Whoop. So in that case, we go back to 1. Okay, there. Now look, we've cleared tier 1. We've got our 8% internal rate of return. We've distributed some back to the GP as well. So of this 10,000 that's going to this investor group, we're saying that the share each investor gets within their own waterfall is based on their relative total investment against all other LPs relative to how many LPs exist based on these start and end dates. And you can see the monthly, where did I do it? In the cash plan here, this is the percentage of each LP based on when they've joined over time. So you can see here as they join on, you're getting diluted, diluted, diluted. Then we have everybody on. There's the shares. Now note here, if there were distributions, it would only go to, these 5 investors if there were any profit distributions here that were made. Then as more come on, we've got profits distributed. Now that goes evenly based on the total investment of each investor relative to the other investors. The GP is the same GP in all these cases, so that's just the other side of the deal. They're getting 1,500 here in this case. We're getting into actually all the way down to the 3rd tier, which is a 20% hurdle rate, and that's how it works. And all these waterfalls are unique, are dynamic. They start based on the start date. You've got a discounted cash flow analysis on each of them as well. And you can see 2 through 30. These are all for each investor, and they all work in the same way. We've got an annual cash flow summary that shows each investor, total invested, total returned, and then the timing of those investments and returns. And this is the GP. So again, this is the same GP in each deal. So this is how much they're contributing in total and receiving back based on distributions. You've got the monthly cash flow does the same thing, what I just explained, but on a monthly level. You've also got, let's see, this is GP total summary, and then you've got individual summary. So you can actually select investors and see their individual contributions and distributions, their internal rate of return, and a chart therein. So it's pretty cool. And yeah, that's pretty much it. So this is a really cool fund tracking model for preferred return situations. Multiple hurdle rates, multiple distribution rates, very flexible. This is a really cool model. So the purchase price, if you want to use this template, is going to be $125 one-time fee. The link will be in the description box below. And that's about all I got to say on it. Don't forget to like the video, subscribe. Oh, so if you want to expand this past 30 investors, you can do that. You just drag down all of these columns as long as you want it to go. You would, on the cash flow planning, you would start to drag all of this data down the same way. These are all dynamic formulas. Um, let's see, drag these down. Now the month, let's see, start month. I'm just making sure. Oh, this is index. I'm just making sure this doesn't have to be. Yep, that's fine. So it's not index double match. It's just an index match. So all these can be drugged down as many as you have. What else? Let me look at these other formulas. This is all dynamic. This would work for as many investors as you had. This None of this changes. All this is fine. Okay, so that's good. Here you would just extend your drop down to include. You can just go to data validation, and extend that past row 32 as long as you wanted to. So you could select however many investors. Everything else is completely dynamic. GP totals, nothing would change here, except, well, you would have to extend these down, make a space here, so you could extend both of these down more, and update the sum totals for each of those, but not too difficult. These would not need to change. Monthly cash flow, again, same thing, just extending these formulas down and making sure the total sum up the total investors that you have. Again, nothing complex, just simply inserting rows and dragging cells down. Annual cash flow, same thing. And then what you would do, so you have to actually have all this logic. So you would just go to right click one of these tabs, hit make a copy, and copy any of the 1 through 30 tabs. And you could do that as many times as you want. And then just relabel the tab up in B1 at whatever. So to do 31, you would relabel this 31 here, and then it would pull from all the data based on the identifier here. You would have to make sure these identifiers keep going down in order, so 30, 31, 32, etc. And that's it. And you could extend it as long as you wanted. But that's all I got for you. I think this is a really awesome fund management tool. You can use it for forecasting based on expected deployment and profits. You can also use it for tracking what actually has happened. And yeah, I mean, I've done a lot of joint venture stuff, but this is a really cool one that has investors with different start and end dates in the same fund, all with their own waterfall structures. And this cash planning tool, this logic is unique. I've never done it. I think it's really cool. It's intuitive. It makes sense. And again, it goes for up to 20 years worth of time on the whole fund, and then any individual investor can go for up to 180 periods. Now, if it's monthly, that would mean 15 years. If it was quarterly, well, that would mean, I don't know, like 30, a lot of years. If it was annual, then 180 years. Obviously, that's not going to be the case, but and you can adjust the compounded rate or the compounded periods, what they are here. 12 would be monthly, 4 is quarterly, 1 is annual. Uh, and yeah, all these preferred return rates will adjust based on the compound period. So that's all dynamic. Really cool model. Enjoy. I'll see you guys on the next one.